Understanding the real-world impacts of multiple businesses can be a complex and time-consuming process for investors seeking to react to a changing market environment quickly and effectively. Sue Saville reports on how financial services company Moody's believes that AI and fintech are strategic enablers for providing sustainable finance solutions to their clients.
So many of the factors that investors must assess are not found in the balance sheets of companies, but relate to aspects like supply chains, employee brand, reputation or climate impact. The real risks go beyond the financial, requiring multi-stakeholder insights into the environmental, social and governance considerations that underpin sustainable finance. Andrea Blackman heads up the ESG Solutions Group at Moody's. Andrea, how do your services help clients with their complex risk modelling and valuations?
At Moody's ESG Solutions, we're really focused on pulling together data, metrics, and transparent frameworks that allow people to evaluate, model, and manage risk. What sustainable finance helps people to do is set up goals and frameworks and objectives that they're going to manage their investments toward. And then it gives the market the ability to monitor and screen for those different criteria. And it just allows for the greening of the economy and the evolution toward responsible capitalism, where companies are able to clearly articulate what they're trying to invest in order to achieve, and investors are able to understand what those initiatives are and then deploy their capital appropriately.
Environmental, social and governance considerations have transformed investment decisions in just 5 short years since the Sustainable Development Goals of the Paris Agreement. In 2015, under €5 billion were invested in European sustainable funds. Now that figure is over €50 billion and growing. The fourth industrial revolution has begun, with innovation and ESG intrinsically interlinked. Artificial intelligence and fintech are strategic enablers for the monitoring, measuring and managing of ESG risk, according to Martina McPherson, Senior Vice President of Strategic ESG Engagement at Moody's.
There's enormous potential for artificial intelligence, blockchain, fintech applications generally, and environmental, social and corporate governance information when and where information gathering of big unstructured data is concerned. Ultimately, AI can help to break down information barriers and biases. It can actually look at modernizing information architectures for really business-ready and real-time ESG and other data solutions. As far as the social dimension is concerned, which is very often linked to more qualitative information, we also need the next generation of ESG information tools that can help us to quantify, measure, and benchmark the implications for the social dimension.
And in the social dimension remains human capital, with talent management a prerequisite for long-term success in innovative, sustainable fintech. The next generation of leaders is already here. Young executives like Kiran Guiliam-Bahari of VE, who values collaboration to find solutions for issues such as climate change.
Climate is a very multifaceted challenge, and in order to address it, you need to build quite a sophisticated array of tools in order to serve the different needs of banks, of insurance companies, and of corporates as well. And it's been by collaborating and innovating together that we've been able to build kind of a solution suite that can serve all of those different needs.
To achieve the UN's Sustainable Development Goals in this decade of action, the right tools are needed to translate macroeconomic developments and microeconomic impacts, so companies, issuers and investors understand how environmental and social factors collide to create new challenges. ESG has moved from a niche investment consideration to centre stage, with AI and fintech helping build more resilient financial markets.